part 11 of the free beginner trading course that I'm putting right here on YouTube. So we've been through a lot already, and the last few videos, 8, 9, and I think 10 have all been technical analysis. You've been learning targets, stops, a little bit on risk reward, entry techniques, right? The 50% stuff, premium discount, opening price logic, so on and so forth. So there's still a couple more things that you need as a beginner to really get a more well-rounded education, before you go into other stuff like the advanced. I'd say the advanced course, like the Smart Money Sniper course, is probably a bit more advanced. And so risk management, right, is one of the 3 pillars to a successful trading career or successful trading, however you want to look at it. So one of them is the trading your edge, right, or your strategy. We've been over that already. I gave you pretty much a free strategy. The second pillar could be, say, the psychology side, which we really haven't gone over yet. And the third one is money management, right? Risk management. And that's what this video here is about. So you'll have to, forgive my cringy picture here with a little bit of money. Anyway. All right. So part 1, why risk management is crucial. Right? Capital preservation. And I know today might be a little bit boring. There's a lot of notes, but the final thoughts portion is a banger. So you got to stick around. But there's not a lot of chart work here. But trust me, this stuff is as equally important as technical analysis. Okay. So capital preservation. Risk management helps preserve trading capital by limiting the amount of money a trader risks on each trade. By setting clear rules for position sizing, stop losses, and RR, right, risk reward ratios, traders ensure that even if they encounter a losing trade, or even like a series of losing trades, I would throw that in there too, the loss is small and manageable. This prevents a single bad trade or losing trade from wiping out a significant portion of their capital, or say of a funded challenge or combine, something like that, allowing them to continue trading and recover from losses over time. Essentially, risk management acts as a protective barrier that safeguards a trader's capital against excessive and potentially crippling losses. So, in other words, in layman's terms, risk management is key, is absolutely key. Moving on. Emotional control. Risk management plays a crucial role in preventing emotional decision-making by providing a structured approach to trading. When traders have predefined rules for risk, such as position sizes and stop losses, they are less likely to make impulsive decisions driven by fear or greed. Okay, that's very, very important right there. These rules help keep emotions in check as they remove the need for on-the-spot judgment calls during stressful market conditions. By sticking to their risk management plan, traders can maintain discipline, avoid panic, and make more rational, objective decisions, ultimately leading to more consistent and profitable trading I would say potentially profitable outcomes. I know I didn't get to edit this too much, but I wanted to get this done today since it's a holiday and all that kind of stuff. So I would definitely throw that in there. But yeah, so again, the last part, right? Capital preservation is key. And this part, emotional control. So I was reading last night, and I told you guys in the Discord about it. Jordan Peterson, right? 12 Rules for Life. And there was one of the pages I read yesterday. He's talking about like vision for your life and stuff. And I'll read you. There's only like 3 sentences in this paragraph, but I'll read it to you real quick. It says, "It is not vision as such, and not a plan devised to achieve a vision that is at fault under such circumstances. A vision of the future, the desirable future, is necessary. Such a vision links action taken now with important long-term foundational values. It lends actions in the present significance and importance. And here's the banger. It provides a frame limiting uncertainty and anxiety. Having a vision, right, provides a frame limiting uncertainty and anxiety. So when we talk about controlling emotions, or at least controlling your actions, having a plan for whatever may happen in the market is going to help reduce anxiety and eliminate the need for eliminate the need for on the spot judgment calls. So for those of you that have been trading for a while, you I don't know what's going on there. You probably have been through that before, where you're in a trade and you don't really know like what's going to happen, right? You might be confused. Should I move my stop? Should I just get out? Should I hold it? Should I just go watch John Phibbs' YouTube channel or something? Like, and when you're in the moment, you usually, in that sense, do not make the best judgment calls, right? If emotions are high and you can't really figure out what's going on, that's usually when you make the worst, absolute worst decisions, okay? And so when we have rules like this, when we structure things, we're not going to reduce anxiety altogether. I'm not going to say like, oh, you're not going to have any anxiety whatsoever. But when it's structured like this, you have rules to follow and stuff, you're going to reduce that anxiety. So easy example, like if you take a trade and you have no stop loss on, you have no TP on, you probably put on too much size, right? And now you don't know what's going to happen. Well, you could take a small loss, you could take a big loss, you could take a small win, you could take a big win, and you have no idea what's going to occur because you're like a ship out to sea, right? Who was it? Seneca, who said, if a man knows not which port he sails, no wind is favorable, which is more or less like knowing where you're going, right? But having that plan is very similar. When you have a structured plan like stop losses, TPs, and stuff like that, well, it's either going to come down and hit me and get me out, or it might flounder around and I'll just break even, or it's going to go my way and I'll be able to hit TP. So now we have some, predetermined conclusions about what the market is likely to do. So now there's not going to be as much anxiety, okay? In theory, at least. All right. Moving on. Consistency in trading. All right. A lot of people ask me about consistency. How do I become consistent? Well, we can talk briefly about it. This is all risk management, by the way. Okay. Managing risk allows for steady growth by ensuring that losses are kept small and controlled, which in turn protects the trading account from large drawdowns. That is what you do not want, okay? You do not want large drawdowns. You'll have drawdowns, but you want to try and do your best to eliminate large drawdowns, okay? And we got a lot more content than this, so just stay here, all right? By risking only a small portion of capital on each trade, traders can avoid the devastating impact of consecutive losses. And that will happen too. Okay. Taking 2, 3, 4, 5 losses, hopefully not more. I think you're doing something wrong if you take more than 5 losses in a row. But I do have a video on that. It's one of the first videos I put out on this channel when we started this community, dealing with drawdowns, got the Pepe on it. So I have videos on that, or at least a video on that. This cautious approach allows profits to accumulate gradually over time while minimizing setbacks or drawdown. As a result, the trading account grows steadily without the wild swings that can occur when risk is not properly managed, helping traders maintain a more consistent and sustainable trading journey. So if you're a fan of Mark Douglas, right? If you've read Trading in the Zone or Disciplined Trader, both really, really good books. And if you don't have those, you need them. Look at that, book recommendations free of charge. Okay. Throw that in there. Or if you've watched his some of the stuff that he has on YouTube, right? And he talks about like the boom and bust cycle of traders, big losses, big wins, so on and so forth. That's kind of what they're referring to here. Okay. So there you have it. All right. And I'll just briefly do this one more time. So there was part one, why risk management is crucial. Capital preservation, that's key. Emotional control, or at least emotional management slash anxiety reduction. And consistency, at least in the loss growth aspect of, say, the equity curve, for example. Okay. Part two, key components of risk management. Position sizing. Decide, and this, again, all of this is very, very important, and you should be taking notes, okay? Decide how much of your trading capital you are willing to risk on a single trade. A common rule is to risk no more than 1 to 2% of your total capital on any trade. And I want to make sure I put this in here. Anything above 2% to most traders is considered high risk and may not be suitable for long-term success. Okay? So every trader has their own account, whether it's a personal account, demo account, funded account. I know a lot of you are funded now, right? And so you know what your account balance is, and it's really easy to figure out what 1% is or 2%. Okay? Now, I would even say, and I put this at the end, and we'll get to that in a minute, but you can even go less than 1%, okay? And despite whatever you might believe, you're allowed to do that, okay? It is acceptable to go less than 1%, 0.5%, okay? Maybe even 0.25%. That's really more for like funded traders, like 0.25%. Because I mean, like if you have a $100 account, I mean, I can't really help you with that, or even like $1,000 account, you're going to be arguing like, oh, well, I can only risk like $10 or $5. Like that's not going to do a lot. I mean, in the short term, you're probably right, but it's not about the short term. It's about the long term. And I'll throw this in here too. If you can't manage $100, if you can't manage $1,000, you're not going to be able to manage 10,000 or 100,000 or anything above that. Most likely. Okay. So there's that. All right. Setting stop losses. Having a stop loss on each trade is crucial because it acts as a safety net, if you will, automatically closing a trade when the market moves against you beyond a predetermined point. This helps limit potential losses, ensuring that a single bad trade or losing trade doesn't wipe out a significant portion of your capital. Without a stop loss, you might hold on to a losing trade in the hope, oh, what's that word? What's that word? Right? We don't use that. Well, we shouldn't. Right? We don't, hope is not a strategy. And that is going to be one of the next couple of videos, by the way. All right. So you're getting a little bit of juice there too. Hope is not a strategy. Okay. Let's restart. Without a stop loss, you might hold on to a losing trade in the hope that the market will turn around, leading to even greater losses or a greater loss. A stop loss enforces discipline. There's that D word. A stop loss enforces discipline, helping traders stick to their risk management plan, protect their capital, and avoid emotional decision-making in the volatile market conditions. Right, Naruto. Hope is not a strategy. It's not. So, there you go. All right, here's a big one. RR, or risk-reward ratio. The risk-reward, or RR, is a measure used in trading to compare the potential risk of a trade, which is the amount you could lose, to the potential reward, which is the amount you could gain. It's calculating, all right, we can cross that out. It's easy. For example, if you're risking $100 on a trade with the potential to earn $300, your RR would be 1 to 3. Okay? Or risking 100 to make 200, your RR would be 1 to 2. Very simple, very easy. But there's a very important aspect to this, which we're going to get into in just a second. A favorable RR, which means anything higher than a 1 to 1, 1 to 2, 1 to 3, so on and so forth. A favorable risk-reward ratio ensures that the potential rewards outweigh the risk, meaning that even if you only win a portion of your trades, which is everybody, nobody's 100%, your profits can still exceed your losses over time. And I believe this is where I put that image in. Okay, yeah, I did. Cool. Okay, so I was not allowed to teach certain things back in the day. Now that I'm on YouTube, I can teach whatever I want, which is cool. And equity curves is one of them, right? And so this is very, very simple, very easy. And this is just a idea. It's a concept of your equity curve. So does everybody understand what equity curve means? It means your account balance. If you take a winning trade, your account, say goes from $1,000 to 1,050, right? So you have like a gain. And then if you take a loss, say it goes from 1,050 to like 1,025, right? And so on and so forth. So in the grand scheme, based on the week, but I would probably zoom out a little bit more and say like for the month, for the quarter, for the year, right? So you can imagine this as 6 months or a year or even maybe 5 years, for example. Your ideal equity curve should be large increases and small decreases. Okay. And that's kind of the point, right? Big win, small loss, big win, small loss, so on and so forth. This is the ideal equity curve, which is your account growth over time. I had a student that asked me, and I'd rather have you ask in the Discord, by the way. I don't really like one-on-one DMs because nobody else gets value except for that person. But, and yeah, I had to throw that in there too. But they had asked me about their equity curve, and they were taking wins, they were taking losses, and their equity curve was more so flat. And they said, well, what can I do? Like, I'm taking good wins, but I'm taking, some losses too. Like, what can I do? And I told you guys the answer to that. And I said, you got to stop taking the bad trades or, at least start losing less, right, on those losing trades. And, a couple of weeks later, they got back to me, and sure enough, their equity curve, based on what they told me, was fixed, because now they're able to take smaller losses, and you could even keep the same size wins. But the whole point is that your wins have to be bigger than your losses, or your losses bigger than, your losses smaller than your wins. Okay. And that's what that looks like. Okay. So this is what your focus should be for the long run. And we should not put too much emphasis on any single one of these trades. All right. Series of trades perspective, as Mark Douglas would say. All right. Part 3. And I think there's only 4 parts and then a final thoughts. And then we'll go over to the NASDAQ from Friday. Part 3, common mistakes in risk management. All right. Over leveraging. Some of the repercussions of over leveraging are magnified losses, capital wipeout, aka blown account or failed challenge, failed combine, all that. Margin calls. Who is margin and why is she calling? And emotional stress. All right. Magnified losses. Leverage increases the potential size of both profits and losses. If a trade goes against you, the losses can be much larger than your initial investment, potentially leading to significant financial damage. In futures, your account can go negative. It's never happened to me, okay? But it is possible. You can, if you go into Google and you look up, oh hell, I forgot who it was. I think it was like shortsellers.com or something. Yeah, you'll find it. They went negative too. They got wrecked. So you can go investigate that if you want. Capital wipeout, aka blow an account. All right, leverage can work for you as well as against you. That's in every risk disclaimer, you know, in the trading space. Okay. Margin calls, hopefully that's never happened to you. If your leverage position moves against you, your broker may issue a margin call requiring you to deposit additional funds to maintain the position. Failure to meet the margin call can result in the forced closure of your position. And that's pretty much, these are very similar, and that's not what you want. All right. And emotional stress. The pressure of managing large leveraged positions can lead to poor decision-making and emotional trading, increasing the risk of making costly mistakes. And I touched on that earlier in this YouTube video, right? If you don't have a stop loss on and the market's starting to go against you, and now it's like, uh-oh, this isn't good, and you bring out the H word, oh, I hope it comes back, you're done. You're done. And it's not going to end well. And your career is going to end up being cut short. And then you're going to blame everybody else except you. All right. Another mistake, over trading. Some traders take too many trades and end up in a worse position than when they started. Here's a big one. More trading doesn't equate to more profits. All right. You want to be fairly selective in your trading. Instead of a machine gun type trader, try focusing on quality setups like a sniper. Why do you think all of you have it's not a logo, but all of you have what next to your name? Is it a machine gunner next to your name? No. It's a sniper, isn't it? Did you ever think about that? Did you ever think about why I made, well, I didn't make it, but I had that made? To remind you to be selective. Okay? Why do you think there's a gold sniper literally in all the videos right next to me? Gold sniper right there. To be selective, not a machine gunner. Okay? Pick your shots wisely. Remember quality over quantity. Okay? Just like your relationships. You don't want quantity like my exes, all right? Quality. Okay? You want a dime. You don't want the pennies. Okay? So, are we all clear on that? Pick your shots. Don't overtrade. All right. So, there was like at least 3 or 2, I guess. Some common mistakes in risk management. Over leveraging, and we did touch on what was it called? The lot size, position size. There we go. Right. We did talk about position sizing. Okay. And then we also talked about over trading. So, because you could even screw this up big time. You could say, all right, John, well, you know, I'm taking 1%, but that, what good is that going to do? What good is taking 1% or even 2% per trade if you take 10, 20 trades in a day and all of them, you know, get wrecked? The whole point was not to, you know, lose 5, 10% in a day, and you still did it. But you did it during doing the wrong thing. Okay. You over traded. And so I threw this in the end for a reason. All right. Part 4, the last part of this video, the psychological aspects of risk management, a little bit on psychology. All right. Discipline, there's that D word again, and patience, right? 2 very, very big things that a lot of traders struggle with, even myself. Okay. Discipline and patience. Risk management enforces discipline in trading by setting predefined rules for how much a trader is willing to highlight this. I highlighted the words, but highlight this too. predefined rules for how much a trader is willing to risk on each trade, each day, and each week. Okay, do not miss that. Max risk per trade, max risk per day, max risk for the week. Okay, now I will, since a lot of you are funded now, I will go ahead and give you this too. Most of you are funded with Top Step, and the Top Step offers, right, the DDL, the max daily limit, and that is now customizable. So you can set your own daily loss limit. So if you don't want to lose more than, say, $500 a day, you can set it to where, all right, it's set at $500, and if you lose, then, you know, at like 490 and then it hits 500, your trade will be automatically closed, and then you'll be locked out from taking any positions for the remainder of the day. I think that's a really good tool. Some traders, you don't have to have it. They took it away now, so you could really just screw your trading up if you want to, but that's a tool that you're able to utilize, and that's for each day, each day. All right, but I'm telling you, you could take that further. Max risk per trade, per day, and then per week. All right, so just for an easy example, you don't have to copy me, but just for an easy example, you could say, all right, I'll do 1% each trade, but I'll do a max of 3% per day, and I'll do a max of 6% a week. So if I lose 6%, you know, say 2% on Monday, don't trade Tuesday, screw it up on Wednesday, and then Thursday morning you hit another loss. All right, I'm down 6% for the week. You cut it. Okay. So it's all about not letting losses accumulate. Okay. And then cutting your trading whenever you start to realize that you're going on tilt. All right. These rules, such as fixed position sizes, stop losses, and RR, create a structured approach that traders must follow. By adhering to these rules, traders avoid impulsive decisions driven by emotions like fear or greed, and instead make calculated, rational choices. There's that R word, rational. The Stoics use that a lot. The rational person, the irrational person. And we want to be rational. We want to make rational choices. This consistency helps maintain focus on long-term success rather than short-term gains, fostering discipline and systematic trading behavior. Okay? And patience. Patience is crucial in trading because it allows you to wait for high-quality setups that align with your strategy rather than forcing trades out of impatience. I think we've all done that. And that works sometimes, but it doesn't work in the long run. Not chasing losses is equally important because attempting to quickly recover from a losing trade often leads to poor decision-making and riskier trades, right? We call that revenge trading. You don't want to do that either. This behavior can result in even greater losses, compounding the problem. By staying patient and sticking to your plan, you avoid the emotional pitfalls that can lead to a cycle of losses, helping you maintain control and protect your capital over the long term. Should we have a profit limit as well? I mean, you can. If you want to do a profit limit, you can. So if you're, Harmon, if say your max daily limit is 500, you could set your daily or your profit limit at, say, 1,500. But the only problem with that, so it's different from like the challenge or the combine versus like the funded account. Because in the combines, you're limited, and this is just Top Step, by the way. I can't speak for everybody else. I don't know how everybody else does their things. But in the combine, let's say the 50,000 account, you have a $3,000 profit target, and you cannot have more than 50% of the total. So of $3,000, that means 50% would be 1,500. So that means out of any one particular trade, you cannot have more than 1,500 in profit. So you have to limit yourself in the combine, and you can't let trades run. And that's like the biggest thing that most people complain about with Top Step, but it's a consistency thing. So I'm assuming, right, that you're allowed to let a trade run, okay, if you have a funded account. So now you're probably not limited on the upside. So now you could probably go for like a $2,000 day or a $3,000 day. Hell, if you're trading NASDAQ, probably so. But that's totally up to you. Typically, I don't mind taking partials and letting the rest run. Or if you like just what we talked about last week and in this beginner series, just 1 to 2s. If you like 1 to 2s and you just want to take that, then fine. But then you can't complain, man, John, I took the 1 to 2 because it's been working really well. But, this one day it went 1 to 10 and I missed out. You suck. You suck as an educator. It's like, well, that's how it's going to be, though. So if you're going to take 1 to 2s, that's fine. And that's great for compounding. But you can't come and complain to me or anybody else that you missed out on a 1 to 10 because you didn't leave a partial and you didn't see something on a higher time frame and you missed out. So it's entirely up to you. And that's why I've always been an advocate for taking partials, because that's the meeting in the middle. Should I hold trades or cut them? Or should I get out? Right? And that's like where you meet in the middle. I'll take partials and I'll let the rest run. So at least we can get paid, and then we can potentially catch a bigger move if there is one. And I don't really know a system that's any better than that. That doesn't include what I just told you, like missing out on a 1 to 10. All right, so moving on to the final thoughts. This, if you haven't taken notes at all, this is it right here, okay? I'm giving it to you. It's not everything. This is an introductory to risk management, but again, if you haven't taken notes, you need to take notes at this particular point right here, okay? So final thoughts, all right? These are some of the main points that we talked about today. Capital preservation is key to long-term success. Protect yourself before you wreck yourself. Check yourself before you wreck yourself. Rules limit the need for on-the-spot decision-making. This reduces trading anxiety, forces discipline, right? Structure. What we're looking for is low-risk, high-reward setups, okay? It's not about quantity of trades, but the quality of trades. Think quality over quantity. Quality over quantity. 1% to 2% risk per trade is ideal for most traders. Like I said earlier, less than 1% is also acceptable. Expect to take losing trades. This is why we manage risk. We allow for losing trades. We allow for losing trades. Let the RR math play out over time. Don't emphasize 1 or 2 trades. Focus on the long-term basket of the trade's perspective. And again, that comes from Mark Douglas. You're more than welcome to read Trading in the Zone, Disciplined Trader. Or there's YouTube videos on that stuff, which I love those. The quality of those videos is pretty lame, but they're old and it's fine. But the content's still pretty good. Risk management must be followed with strict discipline. Work on a disciplined lifestyle so your trading is disciplined as well. You guys catch that? Work on a disciplined lifestyle so your trading is disciplined as well. Patience must be followed with strict discipline. Work on your patience so you don't limit your performance through cutting trades early or taking bad trades out of boredom. That's a big one. I touched on this earlier, but I'll say this again because it's very, very important, even though all of it's important. A trader should know the max risk per trade, risk per day, and risk per week. Walk away if the max risk is met. Okay? Even if, say you got wrecked in the AM session and the PM session offers something juicy. All right, but if you hit max risk, you're done. Okay? And I know that sucks, but you're done. And then I threw this in here because this is a really big one too. There should only be 4 outcomes to a trade: a large win, a small win, a break even, a small loss. Now, large loss is on here, and I'll zoom in just to make sure everybody can read this. I put large loss on there, but guess what? It's crossed out. It's crossed out because this should not happen. That's what we want to eliminate. Okay? So the worst thing that could happen is a small loss. And then the worst thing after that is just a bunch of small losses together. Right? So if you do these things, and I'm not promising trading success, okay? But if you do these things in here and all the other stuff that we talked about, this is the general outcome. Now, sure, you'll have a couple small losses in a row, or maybe like a really big banger. That's fine too. Again, this is just an ideal, but your equity curve over time will do this if you follow a good strategy, aiming for equal highs or equal lows, maybe entering at inversions or something in a discount after a stop run. Okay. While doing this, then your performance should be better. And that's it. So there you have it. I'll leave this up on here just in case you want to take a screenshot. Here, I'll even take my camera off. So if you want to take a screenshot, now's the time to do so. If you don't know how to do that, it's the PRTSC button on your keyboard, print screen. For you Mac users, I think it's that squiggly, weird looking button. And something else. I don't know what it is for Mac. You can Google it, but there you have it. There is your introduction into risk management.